But while we do that, let's also bring in Rana Gupta, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, great to have you with us here on the program. Thanks very much for your time. Let me actually take the conversation in a slightly. You have a global perspective as well, and you of course invest here in India. Are you? And I've been sort of reading at the margin about this that in China, across a range of industries, right, there is a push now to cut supplies, cut output. Basically lessen competition because there's just there's a glut of supply and there's basically deflation, right? Producer price numbers in China have been negative for a while now. Do you think there are any implications of that in specific industries here in India? Chemicals, for example, comes to mind, Rana. What else? I just wanted your sort of starting thoughts there.
Good morning. No, that's an important aspect, and we should talk about it. There are two aspects to it. One broadly macro. After a long while, we see something macro coming out of China. This drive is called in English anti-involution drive, which basically means to cut supply. And we have seen this something like this 2016. Now, if you think about solar cells, steel, metals, electric vehicle, all this, China has huge overcapacity. And the overcapacity comes from the state-owned enterprises. So we do think some consolidation will take place there. Profits can improve at the margin. And global demand supply scenario at the margin can get better. At the first level, I think this makes overly sold and pretty cheap Chinese equities at the margin attractive. And we have seen some money flow into the China share markets. And I think that isn't quite well. On an implication to India, at a flow level, I think this makes China more attractive. But coming to fundamentally, as far as the metal part is concerned, I think that can be benefited positively if the supply cuts really come through. However, I think in the solar and electric vehicle, the overcapacity is pretty massive, and there's not much inflow from China to India. So there, I think the impacts are more global in nature. Lastly, in China, e-commerce also, there is a lot of competition, and that's mostly in the private sector. So I think much of supply consolidation may not happen, but there's just a read across. There's been nothing too much read through for Indian equities as such in that aspect.
So metals primarily, Rana?
Yeah, yes, that's correct.
And chemicals as well? No.
Chemicals, I think one has to, because chemicals is such a broad area, one has to be very specific. Certain chemicals will do well, but I think the issue is that chemicals, there is a lot of oversupply also. So chemicals really have to go bottom up, part by part, and see which chemicals benefit. Certain chemicals will benefit, but even in Indian chemical space, if you look at the larger companies, they are, there are companies who make a lot of it. So at a company level, we are unable to identify that which company will really stand out and benefit. That said, I think at balance, you're right. I think chemical, there are some benefits in certain segments.
Okay, got that point. Rana, hi, morning. So we all know that in India, right now, we're dealing with a bit of an earnings issue. So in this environment where the market's sluggish, earnings are not really picking up quickly enough, just take us through your portfolio construct. Is it more defensive in nature? What are the changes that you've made over the last couple of weeks, if at all? What are you, where are you parking the cash and what are you avoiding?
I think a best way to look at this will be, let's say the last time I was in a channel, I mentioned a pretty positive view on the consumer, on the financials, as well as the infrastructure. So let's see how those have panned out. I think the consumer stocks, particularly in the food tech segment, particularly in some of the select retail stocks, has seen a significant rally. So as in the financial side, particularly the mid-cap banks and the non-banks, which are very levered to rate cuts. Now, these stocks had a good run-up, and the results have not kept up pace. Now, it has to be said, even on a standalone basis, results are a tad disappointing, even adjusting for the quarter one sluggishness that happens. So I think from here on, it's going to be a bit of a patience will be required, because the fundamentals will take some time to turn around. When the asset quality has worsened across the board, I think it will take about 1-2 quarters to stabilize and then come back. Because the stock price had run a bit ahead over last 3-4 months since the time the rate cut and the tax cut happened, I think a period of adjustment, we look at this quarter will be a period of adjustment for consumer as well as the financial stocks. The infrastructure side, we continue to be bullish. I think infrastructure side, particularly real estate and power, will continue to see good demand. I'm referring to top-end real estate and the renewable power plant here. And at the margin, because globally, I think the anxieties regarding trade, anxiety regarding China's oversupply, at the margin is diminishing a bit. That makes some of the global cyclicals that one has avoided, whether it's IT or metals, at the balance or even tactically, tactically a bit attractive than they were beginning of this year.
Hi, Rana. Good to see you in. Tech, I just want to clear that point on tech. TCS went ahead and they said they're going to be pulling back closer on 2% of the global workforce, not because of AI, but because of a talent mismatch. Yesterday, to be fair, actually, the stock didn't react very, very negatively. So that wasn't the reason to sell the stock. But do you think with a lot of this negative news that's coming in there, the IT stocks and the IT sector slowly on that process of actually bottoming out, and then it becomes an investable idea? Or do you say there's too much of uncertainty, you'd rather stay away?
Look, I think on IT sector, the AI is going to be a structural headwind. That is not to say that from time to time we will not get tactical investment opportunities. Now, what TCS has done, basically, I think this is the skill mismatch. I think it has a lot to do with AI, and the way AI is increasing productivity of people. So many people record or not, that's a matter. I think we will continue debating for the next 1 or 2 years, and you will see more on this front. But the broader point is that the IT stocks have the index is down about 15-16% this year, market up about 5%. So they have underperformed 20%. There is bad commentary, and also their clients, they have not closed deals as evident in commentaries of most of the IT companies. But now with trade deals getting signed and US tax cut coming through and all of those things, we do expect a bit of pick up in the deal momentum. All the pricing pressure will remain. I think that is, we have to just accept that fact. And because the valuations have corrected, they look a bit reasonable. There is room for a tactical trade in IT in our view.
Tactical trade in IT. All right. And from the pack, what would you prefer? The ER&D, the large cap names or the mid cap names?
I think because the large cap names and as I said, they remain tactical trades. But I think if someone were to look at somewhat more durable investment ideas, one has to look at companies which are not really mid cap companies, because these companies also by now grown, but where either the management is pretty aggressive in deal wins and going ahead with these deal wins. If you can go through earnings transcript, you will see there are 1 or 2 companies who have got very decent deal wins, even if this macro environment. So I think that is one bucket one should be, relatively speaking, bullish on. The second is the companies where they can do a lot with AI, because I think this AI is one theme which is only going to grow bigger and stronger going forward. There are 1 or 2 companies in Indian IT space where they facilitate AI and agentic implementation with their clients. And I think, and that accounts for a pretty chunky part of the business. I think those are the businesses on a bottom-up basis also we like. But top-down large ITs, I think large cap ITs, they are so big, they will take time to adjust to these realities. And this kind of job cut news that you have heard, I think this is not the end of it. There will be many more adjustments required. But that said, not stock picking is different. There could be room for a tactical trade after prolonged underperformance that IT companies have seen.
Okay. All right. So that's the sense on IT. Rana, what about infrastructure and industrials? I mean, again, here we'll be speaking to one company from that space, KC International, in just the next couple of minutes. After being among the big leaders of the rally back in end 23, early 24, how are you positioned on these stocks? Because at least from a valuation perspective, some of the multiples have cooled off now.
So the infrastructure industrial side, what we like is somewhat, I would have to say, the rare in that industry, that visibility of cash flows. The construction companies, they hardly generate significant cash. And I'm talking about just operating cash flows. And that need not be like today. But we need to see visibility of cash few years down the line, because in our view, the cash should be reinvested for growth and not too much of debt and external funding and liquidation and capital raising perhaps not the best way in our view. With that construct, we prefer the asset owners, and the asset owners, particularly in the renewable power segment. That is one area that we like. On a broader sense, at least here in regionally, we also consider other asset owners as infrastructure plays, and this will be something like a telecom, hospitals. They're also even airports. They're also infrastructure plays. So asset owners, steady cash flows, growing cash flows. Those are the kind of businesses that we like.
All right. Interesting. Yep. Interesting perspective on what sort of you can consider as infrastructure. And you're looking at some of those other related allied sectors as well. Got that point. Rana, thanks very much for joining in. Good conversation as always. Wish you a good rest of the day.